right, then we shall now proceed to our next topic. Our speaker is the Vice President and Head of Research in COL Financial. She regularly conducts market strategy presentations and appears in local business programs as a resource person for stock market matters. She is a business columnist for the Philippine Daily Inquirer, where she talks about personal finance and stock market investing for her weekly column entitled Intelligent Investing. She is also the former president of the Chartered Financial Analysts Society of the Philippines, or CFA Philippines, a position she has held since 2009. To share her insights about the local market outlook, let's welcome to the stage COL's Chief Equity Strategist. Everyone put your hands together for Miss April Lin Tan.
Morning, everyone. Happy Chinese New Year. And thank you for joining us today, despite the occasion. So today, I'll be talking about our market outlook based on fundamentals. Okay, so one of the things I'd like to start out with, because our title is Shifting of the Tides. Actually, the emerging market tide is already shifting. As you can see here, since the middle of last year, emerging market index is actually up by 4.7%. In contrast, the Philippines is down by 7.16. That's based on the middle of last year. And you may be wondering why this is the case. So I'd like to start out by saying it's not the fault of the economy, because actually June had already mentioned how our economy is very strong, and last week the government disclosed the fourth quarter GDP, which strengthened further to 6.4%. First half of 2019, it was 5.6%, and then it picked up to 6% and 6.4%. So it was really very strong. And, among the drivers would be strong domestic consumption. As you can see, inflation has gone down from hitting 6.7% peak in September, October of 2018. And it's now at 2.5%, thanks largely to lower transport and food prices. And aside from that, of course, the very low unemployment rate. Now, this is over a period of more than 10 years, almost 15 years. And you can see how much unemployment rate has gone down. And June had mentioned how, investment spending in the Philippines has gone up to 30% of GDP. When I initially started doing presentations for clients, I remember talking about how we needed investments in this country. And at that time, investments to GDP was only at 19-20%. And now, it's already at 30%. And it's been that way for several years. So that was the driver of GDP. And of course, the increase in government spending. During the first half of the year, of course, there was a delay in the passage of the budget. And that led to slower growth in government spending. But come April, the 2019 budget was passed, and that led to an increase in government spending in the third quarter and in the fourth quarter. So those were the drivers of GDP. So very good outlook for the economy. The tides have turned as far as Philippine fundamentals are concerned. For this year, the outlook continues to be very favorable, and here are the reasons why we feel that way. First, the 2020 budget was passed on time, so we won't have a repeat of the 2019 issue. The BSP, in our opinion, still has room to ease monetary policy. I'll talk about it more later. Faster earnings growth as far as listed companies are concerned. Very cheap valuation, so I'll talk about this in more detail. And of course, the improving global economic outlook. Okay, so remember in 2019, the budget was passed in April, which was several months delay. But for the 2020 budget, it was signed by the President in January 6. And aside from that, we will be extending the government's 2019 budget kasi hindi siya naubos. Okay, what are the details of the budget? We will have a 12% increase in expenditures. And infrastructure spending will actually be increasing so much more. The budget of the DPWH will be increasing by 25.2%, while the budget of the DOTR will be increasing by 45%. So really, this year we'll be seeing a lot of infrastructure spending, and this is really very good for the long-term growth of the economy and also for job creation. Okay, so the BSP, we believe, has room to ease monetary policy, okay, while it is becoming widely expected that the policy rate will no longer be reduced, notwithstanding statements from the BSP governor that if, in his opinion, he feels that there's still room to bring this down. I think the focus should be on the reserve requirement ratio, or what we call the triple R. Now, the triple R is the percentage of deposits that banks are required to set aside. As far as the Philippines is concerned, this ratio is still very high at 14% because the average is below 10% around the world. So even if the BSP does not reduce the policy rate, which is at 4%, it still has room to reduce this reserve requirement ratio, which is currently at 14. Now remember, during the first half of last year, nag-benefit ba kayo nung time deposit rates umakyat hanggang mga 5-6%? Naalala nyo ba yon? Okay, so one of the reasons why interest rates for time deposits went up significantly last year was because you will notice here how after the BSP reduced the triple R, it kept it at 18%. And I already talked about it. At that point, the banks were fully lent out. Halos lahat ng deposits na pautang na nila. So they needed to attract more money to, or more depositors to put in more money. So to do that, they raised interest rates. But naalala nyo, come the middle of the year, biglang nawala na yung matataas na time deposit rates, bumaba na sila. And it's because the BSP reduced the triple Rs, see? Di ba, unti-unti niyang binaba hanggang naging 14% nung end of the year, which extended more funds to the banks. So, reducing triple Rs is another way to ease monetary policy, and we believe that the BSP will use this tool in 2019. And it has room to do that because the target is to finally bring it below 10% by, I think, 2023, no? Whether they'll do it by next year or they'll wait until 2023, we don't know. But definitely there is room to move this going down, especially if inflation stays within the 2 to 4% band and there is demand for money to fund growth. Okay, so for 2020, what are we expecting as far as EPS growth is concerned? Earnings growth of corporates, in our opinion, will pick up from around 8% in 2019 to 12%. And these will be the drivers of faster earnings growth. For the consumer sector, we're expecting to see a turnaround of selected companies that had a very bad 2019, among them DNL, Robinsons Retail, no? So DNL due to pick up in demand, RHI due to the turnaround of its Robinsons supermarket business. It's actually Rustan's supermarket, which is consolidated into Robinsons. For the power sector, it's coming from a low base for the likes of Aboitiz Power and the other companies which had unplanned outages. And of course, there will be new supply coming in, meaning they'll have more capacity to sell. Property companies still expecting double-digit growth due to strength of offices. We still expect demand for retail to remain strong. And of course, as they complete more residential projects, they'll be booking more as well. For the telcos, we're expecting strong growth of data. Okay, and that should drive earnings growth. And finally, valuations. Valuations really are very attractive. So this is a 5-year PSEI band. And if it's in the upper end of the range, it just means that it's very expensive. And if it's in the lower end of the range, it just means it's very cheap. Now, during the past 5 years, if you do a +1 standard deviation, or meaning the high end of the range, the PSEI would be trading at more than 18 times PE. I remember before, we would be maybe around 2013, when the market was considered to be very expensive, we would be trading at 22 times PE. Now we're at 14.6 times PE. This is actually already -2 standard deviations below the average of 17.3. Okay, so just to put things into perspective, what does it mean when a stock is trading at -2 standard deviations? If you're trading at -1 standard deviation, or 16 times PE, it means that during the past 5 years, the market traded at a higher valuation 84% of the time. So the probability, assuming that you believe in mean reversion, or babalik sa 17.3 when rationality comes back, you will make money, the probability that you will make money is 84%. And now that it's 2 standard deviations, the probability that you will make money is actually so much higher, at around 98%. Okay, so at the current valuation, it's really very attractive, because if we were to look at it from 5-year perspective, we traded at a higher valuation more than 90% of the time. Okay, individual stocks also point to the same picture, taking out some of the favorites such as SM Prime, Jollibee, URC, and the likes. You can see that more than half of the PSEI index issues are currently trading at a discount relative to their historical average PEs. Okay, with a select number of companies trading more than 2 standard deviations below the historical averages. So talagang, even if you look at the individual stocks, they're really so very cheap, no? It's not only the index, but the individual issues that are part of them. In fact, the individual issues are trading at even more significant discounts. So really very attractive, which is why we're in some ways also very excited about the market for 2020. And finally, the improving global economic outlook. So what's the reason why the outlook has improved? I remember last year, the outlook for the global economy was really very bleak. There was a survey of CFOs around the world, and more than 50% of the CFOs said that they were anticipating a recession to materialize this year by the 3rd quarter at the latest. So what has happened? Why are we now hearing more and more people saying that the probability of a recession happening has diminished significantly? First, we have easy monetary policy. I remember, for example, early last year, the base case scenario was the US Fed would not be cutting rates. In fact, they would still be raising rates by 1 or 2 times. But lo and behold, what happened? The Fed cut rates 4 times. And it wasn't only the Fed, it was everybody. It was even China, ECB, just exited QE. They went back in QE, cut rates, despite negative interest rates. Aside from that, we have aggressive fiscal stimulus. So there were a lot of countries last year that cut taxes, increased fiscal spending, spend on infrastructure. They knew that monetary policy could only do so much. They had to spend more, for their economies to avoid a recession. And of course, worst of Brexit uncertainties are now over. Looks like there will be a Brexit after the election improved the constituents of the British government, and improving trade tensions. Now, for me, that is the most important factor that had improved the probabilities of the global recession, of course, the outlook for EMs. And I'll discuss it more. So phase 1 of the US-China trade deal is very favorable for emerging markets. So these are the details. No new tariffs as of last December for Chinese goods coming into the US. And in fact, tariffs on some Chinese goods were reduced or repealed. And in exchange, China had committed to increase its purchase of US products by at least 200 billion US dollars over the next 2 years. So why is it good? Well, if you look at this, you know the US-China trade war began in 2018. And you will also notice how business confidence started to deteriorate around the same time. This is because, of course, if you're a businessman and you're trying to make plans, if you don't know how high tariffs can go, you cannot make plans on whether you will expand or not. Kahit malakas yung demand, tatabi ka muna. Let's just wait until there's more certainty. Okay, so that's the business confidence. And if businesses are not confident, they will not spend even if the demand is there. Okay, and a while ago, June showed a lot of PMI numbers where any number above 50 means an expansion, any number below 50 is a contraction. And one of the things that they do when they do a PMI survey is they ask businesses, you know, what's the reason why you're bearish, you're not expanding? And one of the things that people highlighted was, you know, trade uncertainty. So really, it's one of the main worries that, you know, cause these people to be gun shy or hesitant in investing. So for the Philippine market and other emerging markets, what did it mean last year? So you will notice during the start of the year, I'm sure you can remember how strong our market was. And you can see that foreign funds came into the Philippines. Foreign funds are really very important in the Philippines because they account for more than 50% of our value turnover. So what happened after the first 4 months? I would just like to, you know, refresh the news of, or the developments on the trade deal. No? In December of 2018, President Trump said that, you know, we're going to put all tariffs on hold and we'll be discussing. So I remember during that time, the base case scenario was there would be a trade deal sometime in 2019, which is why we saw foreign buying return to emerging markets such as the Philippines. And then what happened in May, of course, President Trump all of a sudden tweeted and said that China has been bad, therefore we will increase the tariffs right away. And look at what happened. Foreign investors started selling emerging markets. In other words, they said, okay, we're now going to just buy US dollar bonds and we're going to buy gold. We're going to shift to safe havens because we don't know what's happening anymore. People just became so worried, and they felt that emerging markets are risky. So stay away from risk off back, and then buy safe haven. Okay, so that said, now that the outlook is so much better, both domestically and globally, and valuations are so attractive, so why are we decoupling? Why hasn't the tide shifted as far as the Philippines is concerned? There are a lot of reasons, a lot of uncertainties. First would be heightened regulatory risk at this point. Second, of course, environmental risk, which is the Taal volcano eruption that's happening. And thirdly, the relevance of the Philippines in the emerging market basket. And because of that, foreign investors are saying, you know, I'll stay out muna, wait muna ako. Okay? So on the regulatory side, I think, you know, I'll just highlight the key events. Okay, December 3, Duterte threatened to sue the water concessionaires for economic sabotage and ordered the drafting of a new contract. In response to the water concessionaires' arbitral tribunal win. Okay? Hindi natuwa ang presidente natin na nanalo yung mga water concessionaires. And there were, in his opinion, onerous provisions of the contract. And it got worse in December 11 because the MWSS revoked the extension of the concession agreement, 2022 to 2037. So talaga natakot yung mga investors. And then finally, when, you know, just when the wounds were healing, starting to heal, January 18 and 19, our president said that he wants to order the review of the LRT contract. And the palace also wants to review the UP Ayala Land Techno Hub deal. Okay, so worst case scenario, revised concession agreement with the water concessionaires is unreasonable, leading to the nationalization of the water concession. And this would potentially mean the bankruptcy of water concessionaires. Other projects with onerous contracts are confiscated from the private sector. And finally, our credit ratings downgraded. So in that respect, I can understand why foreign investors are staying away from the country. They're worried about these eventualities. But as far as we are concerned, we think we don't expect the worst case scenario to happen. There are actually some anecdotal evidence why we don't believe that it will happen. Okay. Right now, we're seeing some of the bits and pieces of the new contract, or some details being talked about by the DOJ secretary and everything. And details of the new contract seem reasonable. They just want to, revise some of the, for them, the onerous provisions, or yung medyo unfair naman talaga tong mga provisions na to. Because they were, when these contracts were initially made in the 1990s, the financial standing of the Philippines was so much different than what it is today. So talagang we need to revise them. And aside from that, hindi naman siya yung kung sino na lang ang gumawa ng bagong kontrata. There are consultations with the technocrats, or those who are very familiar with, what happened in the past, what do we really need, and yung win-win situation, and of course with the private sector, even the concessionaires themselves. Okay, and finally, at this stage, the government cannot afford a credit ratings downgrade because remember, we are undergoing an infrastructure spending boom, and the government really has to borrow so much money. The government is already anticipating a budget deficit of more than 3% of GDP for the next few years. So this would mean a lot of borrowing overseas, and if your credit rating score goes down, it would be very expensive for you to borrow money. At this stage, you cannot afford that, and I think the government is very knowledgeable about that, which, at the end of the day, I feel like, these problems will be resolved. Okay, environmental risk. January 12, the Taal volcano explodes, resulting to significant ash fall, and as of today, we're still at alert level number 4. Meaning hazardous eruption remains possible anytime, any hour, any day. Okay, so that's another risk for us. And of course, I think yung nakakatakot dyan is antagalin. Of course, we're also reading a lot of horror stories and worst case scenarios. Like for me, what's scary is 30% of Luzon's generation capacity is in Batangas. So if they will be affected by how severe the eruption becomes, then, mahirap yun, 30% yun eh. So we will have brownouts. Okay. And irrelevance of Philippines in the emerging market basket. So this is the breakdown of the MSCI emerging market. So you can see that we're not part of the top 10. This is the top 10 countries. The smallest of the top 10 would be Thailand at 2.5%. We're part of the others at 12.7%. But in the 12.7%, there are 16 countries that are sharing that 12%, meaning our share is most likely below 1%. So, if you have a country that accounts for less than 1% of your portfolio, tapos ang daming risk na regulatory, pwedeng pumutok ang taal, yun nga, tabi muna ako. I'll wait until things are better, then I will come back. Because it will not have much of an impact on my portfolio anyway. And aside from that, we're seeing investors focusing more on the large cap issues rather than doing stock picking, buying the small cap issues. Mas nagkakaroon ng bias for larger cap issues. Okay, and of course, the other risk would be twin deficits to result to a weak peso. I think June talked about this. Potential heightening of geopolitical tensions leading to higher oil prices and coronavirus outbreak worsening. But anyway, so what do we think is the right strategy? Okay, on the positive side, we know that the Philippines' economic fundamentals are very good and valuations are really so attractive. You know, the probability of making money is more than 90% at this point when rationality returns to this market. Risks are significant, but eventually they will be resolved. The problem is, of course, when will these problems be resolved? I don't know. Nobody knows. And how low can the market go? Because it can get worse before it gets better. And because of these challenges, although there's a great buying opportunity, it makes it difficult for us to actually pull the trigger and buy stocks. Or, you know, if you own stocks, you know, still holding on to it. So, you know, these are just some suggestions. We still believe that notwithstanding the difficult situation, challenges, and of course, seeing the market go down, which is really very frustrating, we still recommend investors to stay invested. But I think what's more important at this stage is for everyone to focus on managing your risk by thinking long term. You know, you don't buy stocks today with money that you need in a year or two. You know, I think it's time for you to be honest with yourself, to ask yourself, is this money really something that I can hold on to it? In other words, willing kang magpaipit, no? But that said, you need a diversified portfolio. Maybe consider buying an index, an index fund or several stocks, and limit your size, yun na nga, to an amount that you can keep for the long term. No? Don't be too aggressive in buying stocks right now. Okay? So what are some possible catalysts for recoupling or for us to finally, for the tides in the Philippines to finally shift? If we see the revised water concession contract being favorable to both the private and the public sector, and these onerous contracts that are cited by the government to really be onerous, because I'm not discounting the possibility that there really are onerous contracts out there. Another thing is the ABS-CBN franchise is renewed, okay, and the threat of the Taal volcano eruption actually subsides. So these are just some possible catalysts that would allow investor sentiment to improve in the Philippines. Okay, some sector outlook before and the stock picks. Okay, so if you were to ask me what are my favorite sectors for 2020, they would be the consumer sector, the banking sector, and the property sector. Okay, for the consumer sector, of course, it's because of the strong economic outlook that I feel in some ways will be consumer driven. And, you know, since now we're all worried about regulatory risk, consumer companies are less vulnerable to them. So our best ideas would be URC, CNPF, and SSI. For the banks, okay, with the favorable economic growth outlook, we're anticipating faster loan growth. And as the government reduces the triple Rs, we believe this would mean lower funding costs for them, or at least benign funding costs. The negative, though, is last year they booked a lot of trading gains, and we're not anticipating any more trading gains this year. Our favorites would be Metrobank and Security Bank. For the properties, hopefully this year will be much better. So we expect demand to still be strong given lower rates and the strong economic outlook. But I think the other catalyst would be diminished POGO risk, because our government or the president has already said that China will not interfere with our POGO policy. And secondly, the revised IRR for REITs, or retail investment trusts, came out, which should enable our property companies to actually list REITs or REITs. And this will allow them to raise capital, which is really very exciting, no? This will allow them to unlock the value of the rental properties and help them finance their other projects. The key risk, of course, is, if you think about it initially, medyo hindi naman yata vulnerable sa regulatory risk ang properties. But of course, with the Ayala land development, is it? We don't know at this stage. So our best, or our top picks would be Ayala land, Mega World, and Robinson's land. Okay. Telcos and power sector, we also like them, but we'll just talk about the key investment highlights. Okay, for the telcos, we like it because of the strong demand for data, falling share of the legacy business. So yung mga text messages, voice calls are now less than 50%. So that should allow profits to grow faster. And we have the telcos trading at very attractive valuations and providing dividend yields north of 5%, 6%. No? But still, the problem would be poor sentiment due to the third telco threat and possible regulatory risks. But our top pick is PLDT, or TEL. And then for the power sector, what has changed is that oversupply is now projected to end by 2023. And valuations are attractive, dividend yields the same. Okay. Short term, there are some issues. For 2020, there's still new supply coming out, and the power sector is more vulnerable to regulatory environmental risks. So our top pick is AP. AP does not have a power plant in the Batangas area. Their power plant is in Quezon, which is further from Batangas. And according to friends who are from the province, wala naman daw ashfall doon. So mas immune si AP. Okay, so this is a summary of our top picks in our buy below prices. Now, some of our recommended stocks are trading at expensive or still expensive valuations. But we recommend that you wait for them to correct to our buy below prices before you start buying them. Because, it's not a runaway market. The market is not very strong. So we believe that there will be opportunities for you to actually buy these stocks at more attractive valuations. Okay. So in summary, the tide is shifting for emerging markets but not for the Philippines. While our fundamentals are too robust to ignore, we are also facing certain issues that are hurting foreign investor sentiment, such as heightened regulatory, environmental uncertainties, and growing irrelevance of the Philippine market in the emerging market basket. Okay, but we're confident that these issues will be resolved and continue to recommend investors to buy Philippine stocks. However, since we don't know when and at what level the Philippine market will bottom, we would like to stress the importance of risk management, which can be achieved through diversification and proper asset allocation, and of course, thinking long term. And just some closing thoughts. Una, tatakutin ko kayo, no, di ba? No price is too low for a bear or too high for a bull. Pero that said, of course, some words of wisdom for a very rich and very successful investor. Be fearful when others are greedy, and greedy when others are fearful. Madali siyang sabihin pag hindi nakakatakot. Pero pag nakakatakot na, let us remember this. And another word of wisdom from Warren Buffett: the stock market is a device for transferring money from the impatient to the patient. So patience really is a virtue in these difficult times. So with that, thank you very much.